So you've moved to the UK or investing in the UK, and you want to know about the remittance basis and more importantly, the remittance basis tax charge. Check out this video as Louise and I discuss this subject. Okay, so can I change from remittance basis to a rising basis? I have foreign income and I'm a high rate taxpayer in the UK. And let's talk about this because the remittance basis, people go, but if you are living in the UK, there are different ways that you can treat your foreign income.
If you're not domiciled.
If you're not domiciled, and we'll talk about that in a second. But if you're moving recently in the UK, and I'm going to give you a magic number here, Louise, which I would say 7 out of the last 9 years.
Oh,
we'll come back to that.
He's cheating now. He's reading notes.
There's notes. So if you have been in the UK for less than 7 years, I would say that it's totally possible for you to be taxed on just your UK income by HMRC. And you could say, well, actually, I don't want you to tax me on my worldwide income simply because I'm going to keep my money in that country. Okay, so let's imagine you've got £100,000 in the UK. You'd be taxed in the UK on that by HMRC, but you've got $100,000, let's say, in America. And you could say, well, I'm going to use the remittance basis, so I'm going to bring in $50,000. So you can tax me on that $50,000, but you can't tax me on the other $50,000 because I'm leaving it in America. So that's the remittance basis.
It is.
Comfortable with that?
I am. The only downside with remittance, I would say to you, is that after a period of time, which I know Simon's going to come on to, there's a nasty kicker from HMRC because they don't like you doing that. They want to tax you on everything. Yeah. Secondly, the moment you're under remittance basis, kiss goodbye to personal allowance, kiss goodbye to annual exempt allowance. You don't get those.
But I would argue that if you've got in that example whereby you've got $50,000 and you want to bring that into the UK, personal allowance wouldn't really come into it.
If you're already earning over £125,000, or what you're remitting to the UK plus what you earn here is over £125,000, it's not going to affect you on personal allowance. Yeah. It really doesn't matter.
However, I did say at the beginning for 7 years, okay, here's a kicker, because HMRC don't like the remittance basis at all. So what they will do is, if you've been in the country for 7 out of the last 9 tax years, they will apply £30,000 as a charge. So irrespective of how much tax they're going to charge you on your income streams, they're going to slap this extra £30,000 as well.
Why not?
It's small, right? I mean, it's small. Just get it out of your back pocket, pay the HMRC the £30,000 and be done with it. Excuse me. So, and it gets worse because if it's been 12 out of 14 years, then that will go from £30,000 as a basis charge to £60,000. Finally, if you've been in the UK for 15 years, and I'm going to come on to it for 2 different aspects. So strap in, guys. Strap in proper. Because I always talk to clients when we're coming over to the UK, and they say, well, I'm going to live in the UK. I think you're crazy because the weather's rubbish. And I'm talking to people from places like Hong Kong where it's nice. All right, it's humid, but, come on, guys. Why in the UK? It's raining. Just look out the window.
They're never going to hire you to bring in people for holidays.
I know. A place in the sun. Not in the UK. Anyway, that aside, 15 years. Why is 15 years important? Well, you become domiciled. So that means that your worldwide income will be subject to UK tax by HMRC.
Even if you don't bring it into the UK?
Even if you don't bring it into the UK.
You're now forced into being classified as domiciled here in the UK, which means every single penny you earn, no matter where you earn it, must present on that tax return here in the UK.
But what's worse than income tax, though, Louise?
Oh, I don't know. Simon with technology is very excited about.
Well, that is a good thing. That's a very positive thing, by the way. So I pipe down. Inheritance tax. Because let's imagine that. Oh, sorry, if I tread on your foot.
Don't worry. I'm used to kicking
I meant to stab on it really hard. Given your last comments. But the idea behind it is if you are coming to the UK and you've got the assets, your inheritance tax liability would only typically be for the assets held in the UK up to 14 years. And that's a real crucial number, because I always say to clients, isn't it time that you kind of off? And they think, hold on, mate, I don't.
Salmon doesn't mean about killing.
Yeah, well, definitely not that. But equally, I don't mean get rid of them as clients. But I do say to them,
moving out of the UK
it's time to move on, as in go to a different country, because on the 15th year, your worldwide assets would be subject to inheritance tax if you're not careful. I mean, there is the excluded property trust, which can shield you partly away from that, to be honest. But you're still, at risk of all of your assets being subject to inheritance tax, not just income tax, on the 15th year.
And there are some exemptions to inheritance tax. There are some exemptions, so business property and farming property in certain instances. But do you really want your whole world exposed to tax on your passing? Probably not.
Do you want the whole world exposed?
Well, all of your worldwide income and assets.
So many jokes. Right.